Making money from the comfort of your home or even a beach chair is a dream that many of us share. But let's debunk that myth. Day trading is not about hitting a button and watching the cash roll in. It's a journey that demands time and a whole lot of effort. If you are ready to get serious about trading, you're in the right place. Today, we are breaking down 5 indispensable lessons that are pivotal in elevating your trading game to the next level. Without further ado, guys, let's jump right into it. Alright, so lesson number 1, and this right here is something I see so many new traders struggling with. Lesson number 1 is all about understanding order types. It's very important to know what the different order types do and in which situations we should use different forms of order types. This lesson alone can many times make or break a trade. So let's start this video off here by taking a look at the different type of order types and what they actually do. So first of all, order types are basically how you buy or sell an asset. And there are basically 5 different ways to do this. First of all, we have the buy limit order, and we also have the sell limit order. For the buy limit, let's say that this right here is the price. Let's say that the asset is currently trading at $100. And what the buy limit basically do is that it makes you place a limit order at a certain point in the market. So if the market is currently trading at 100, you can, for example, place a buy limit order at, let's say, 90. So if you place a buy limit order at 90, what this basically means is that if the price goes down here towards 90, it hits 90 or goes below, that means that your order will be filled and you now bought the asset or bought the stock. The buy limit order makes it so that if the price is at 90 or below, your order will get filled. So you may of course wonder, what happens if we place a buy limit order at, for example, 110 while the market is trading at 100? Well, what you basically tell your broker then is that you want to buy this asset if the price is at 110 or lower. So you will actually, if you place a buy limit order at 110, you will actually buy the stock right away at 100. So let me show you guys how this works in the real market. Right now, as we're speaking, I'm using TradingView, and I'm using the TradingView paper trading function, which allows you to trade for fake money here and practice on TradingView. By the way, guys, I will make sure to leave a link to TradingView down in the top of the description of this video. But now let's take a look at the limit order here. So what we do is that we go up here to our order tab for the paper trading, and we want to make sure that we are on the buy tab. Then we go down here to where it says limit, for short limit order. And remember what the limit order does? It basically makes us place a buy order at a certain level. So let's say we place a buy order at 27,500. Right now, as we're speaking, you can see that we are trading at 27,530. But let's place this order right here. And you can see that our buy limit order appeared here on the chart. What this means is that when or if the price comes down to this level right here, 27,500, then we will buy the asset. But now I want to show you guys what happens if we set a buy limit order above the current price. So let's say that we place an order at 28,000 while the price is currently at 27,500. This will actually mean that we want to buy the price if it's at 28,000 or lower. So if we click buy right here, you can notice that we actually bought the asset right away, and we are currently in a position. The sell limit order is the exact same thing, but the opposite. Let's imagine we have a price here trading around $100, and what the sell limit order basically does is that it allows us to sell for a certain price. So if we place a sell limit here at 110, this basically means that when or if the price goes up here and reaches 110, we will sell the asset. So let's take a look at a real life example once again. We make sure that we are on the limit tab, but this time we go to sell. So let's, for example, say that we want to place a sell limit at 27,600. We type that in and we press sell. And as you can see, now our order type appeared here on the chart. This means that if or when the price goes up here to the sell limit, we will sell the asset. The next order types I want to talk about here is first of all the buy stop order and the sell stop order. These two order types should not be confused with a stop loss, because these two order types are basically the opposite of the buy limit and sell limit order. So let's start by taking a look at the buy stop order here to explain this. So let's once again say that we have the price trading here at, around, let's say once again, around $100. And when it comes to buy stop orders, what we basically do here is that we place an order that tells us to buy something only if the price goes up to that specific level. So we can, for example, place a buy stop order here at 110. And this will give an order to our broker that if the price goes up to 110, then we want to buy the asset. So this is pretty much the opposite of the buy limit. The same thing is true for the sell stop order here. Once again, let's imagine that the price is currently at 100. What the sell stop makes us do is that, let's say we place a sell stop down here at 90. This makes it so that only if the price goes down here to the 90 mark or below, that makes us sell the asset. All right, guys, so let's take a look at a real life example of the buy stop and sell stop order. So the first thing we want to do now is that we want to go here to where it says stop, the stop order type. So we press it right there, and let's start with the buy stop order. And remember, what the buy stop order makes us do is that we choose a level where when the price reaches this level, we buy the asset. So for example, right here, we can set our buy stop at 27,600. We go down here and we click buy to execute the trade. And then you can see that our buy stop order appeared here on the chart. This basically means that when and if the price goes up to this level, we will buy the asset. And the buy stop order, we can actually, let me show you, we go back here to the buy stop. And if you try to place a buy stop below where the price is currently, you can see right now we're trading at 27,540 around there. So if we try to place a buy stop order below this point, you can see that it says that the order price is not appropriate for this order type or direction. So you can see that you can only set the buy stop order above where the price is right now. Let me show you guys this example for the sell order as well. Let's actually delete this order type where we are right now. Remember, the sell order, in this case, we can actually choose the price 27,000 because the sell order makes it so that if the price goes down to a certain point, we sell the asset. So let's execute the sell stop order right here. And as you can see, now a new order appeared here on the chart. This means that if Bitcoin falls all the way down here to 27,000, we will sell Bitcoin. The last order type I want to talk about is the market order. And the market order is very simple. This basically means that we buy or sell the asset at the current price. And let me show you guys how this works in a real life example. This time we go to where it says market here, which stands for market order. And let's say we want to buy for where we are right now. You can see right now we are at 27,500. We can simply press buy. And as you can see, we bought at that price and we are right now in a trade. Let's say that we now want to sell the position at market. Then we basically go here to where it says sell and we press sell. Now we sold the position, and in this case we actually got a small loss. The next lesson I want to talk about is all about market structure. And market structure is something that every single successful day trader understands intuitively, and this is something you really have to learn before diving into the markets. Alright, so there are a few concepts that every single day trader needs to understand about the structure of the price. So now I want you all to take a very close look at the picture right here. The very first thing we need to know here is that we have highs and lows. So for example, we have one high here, we have one high here, and one high here, while at the same time we have one low right here, we have another low right here, and another low right here. And we can use the highs and lows to identify whether we are right now in an uptrend, or in other words, a bullish trend, or if we are right now in a downtrend, or in other words, a bearish trend. In order for us to have an uptrend in the market, and it's very important to be able to identify uptrends because, for example, many trading strategies will only work in uptrends. But in order to have an uptrend, we need to have at least one high and then a higher high, and we need to have at least at the same time one low and then a higher low. So when we have two consecutive higher highs while at the same time we have two consecutive higher lows, then we are in an uptrend. And the same thing is true for the downtrend. So in order for us to have a downtrend, we need one high and then a lower high, right? So we need one high and then a lower high, but at the same time we need to have one low and then a lower low. So you can see that for this particular example we're looking at right now, we actually changed the direction of the trend when the price broke this point right here. Because think about it, when the price went below this blue line right here, then we actually confirmed that we will now have one low and then a lower low, and this means that we are in a downtrend. However, let's instead imagine that the price went something like this and actually printed a higher low. You can see we have one low right here and then a higher low, while we at the same time printed a high right here and then a lower high right here. Now I want you guys to pause this video and tell me, are we currently in an uptrend or are we in a downtrend? Well, the answer is that after this higher low right here, then this price is actually not in a trend at all. We can either be in an uptrend, we can be in a downtrend, or we can actually be going sideways. This is usually what we call a trading range, meaning that we have no trend at all. Many times you want to avoid markets that look something like this, because within the trading range, the price is highly random and it can be hard to get an edge on the market, and we need a trading edge in order to make money on a consistent basis. The next lesson I want to talk about is price action, and price action is the heart of trading. I really like to describe the difference between market structure and price action with an analogy. And that analogy is that imagine that you draw a line in sand. The structures and patterns that will be left behind are the market structure, while how your hand moves, such as how fast are you moving your hand and in what way are you moving your hand, that is price action. So to understand price action, I want you all to take a look at these two examples. Let's say that we have a support level right here. We split the screen in the middle. So this right here is example 1. And this right here is example 2. And in both these cases, we have a support level here at the same level. In both examples, we start off here with a strong movement towards the downside and towards the support. However, in example 1, after we reach the support, we start to see some spinning top candles and doji candles appear here. So the price might look something like this. I hope my drawings are not too ugly. While in example 2 here, after we reached the support, we saw a strong green candle. This is what we call a momentum candle, and together with the previous red candle, so together with this candle right here, this green candle actually engulfed the previous red candle, and this is what we call a bullish engulfing pattern. And there's a bullish Japanese candlestick pattern that actually indicates a potential reversal to the upside. So the difference between these two examples is that for both examples we have the same market structure, and the market structure in this case are that the support here is on the exact same level. So you can imagine that both of these are from the exact same charts, but we can see here that the price action, so how the price is reacting right now, in example 1 we had lots of hesitation, while in example 2 we had a strong reaction from the support level. This right here is the essence of price action. Price action is all about how the price is reacting to the previous market structure and how the price is behaving right now. So now guys, the time has come for lesson number 4. And lesson number 4 is critical. This right here is what allows us to actually make money in the markets, and this is something called opportunity confluence. And you may of course wonder, what do I mean by this? And trading confluences is basically when we combine multiple technical variables or combining multiple techniques here in order to get high probability trading setups. So we might, for example, combine market structure with price action. We can also combine it with other things such as indicators, chart patterns, candlestick patterns, and so on and so on. But the important thing here is that we need multiple signals happening at the same time in order to take our trade. So let's, for example, just take a look at this example right here. Step number one is to identify the trend direction. In this case, we can see that we're printing consecutive higher lows. You can see one low, higher low, higher low, higher low, while at the same time, we're printing consecutive higher highs, one high, higher high, higher high. So we're printing both higher highs and higher lows, and this means that we are in an uptrend. And now let's take a look at a very simple example of confluences. So remember, confluences is when we combine multiple tools. So first of all, we are in an uptrend. Another thing we can identify here is that we had a resistance right here. We got rejected 2 times at the resistance, right? You can see we got rejected 1 time, 2 times. Then we broke the resistance right here, and then we actually flipped. You can see the previous resistance flipped and became support right here. So now we have 2 things happening at the same time. We are in an uptrend, which is a bullish signal, and we are also at a potential support. So now we have 2 confluences happening at the same time. The third thing we can actually use in this example is that when we came down and tested the support, you can see that we actually printed a candlestick pattern. So this right here is price action. Candlestick patterns are related to price action. And the specific pattern we printed right here was an inverted hammer. And the inverted hammer is a Japanese candlestick pattern indicating a potential reversal to the upside. So now we have 3 confluences. We have 3 bullish things happening at the same time, and many times this is enough for us to take our trade. But some trading strategies requires even more confluences, perhaps 4 or even 5 confluences happening at the same time in order to be confident to take our trade. In this case, one could also argue that we had some sort of large pattern appearing right here. As you can see, one could look at this as some sort of an ascending triangle. And an ascending triangle is a chart pattern, and you can definitely use chart patterns as yet another confluence. However, this pattern, it's debatable if this one is valid in this case. I think in many times it's better to keep it simple, and the factors we talked about earlier is definitely enough to take this trade. All right, so the final lesson, and perhaps the most important lesson in this video, is about a concept called expected value. And expected value is a term that you will hear a lot in, for example, poker. Having a deep understanding of expected value and acting on that expected value can be the difference between an amazing poker player and a struggling one. And the exact same thing can be applied in trading as well. Expected value, or for short EV, is equal to the win rate times the win amount minus the loss rate times the loss amount. And in order to be profitable on a consistent basis, you need to have a trading strategy that gives you a positive expected value. Without a trading strategy with a positive expected value, you have no chance making money on a consistent basis. And to show this, let's take a look at an example. So let's say we have an expected value equal to, let's say that our win rate is 60%, or in other words, 0.60. And our profit target is set so our win amount is 100. So this is the win rate times the win amount. And then we need to take minus the loss rate. And because we have 60 win rate, we have 40% loss rate. Or in other words, 0.40 times the loss amount, and we have our stop loss, so we lose 100 when we lose the trade. This is equal to 0.60 times 100 is simply 60, and then minus 0.40 times 100 is simply 40. So in this case, our expected value is 20. And let's think here, what does this mean? Does this mean that we win $20 for every single trade? Well, not really. Because remember, in 40% of the cases, we will actually lose $100. But what this 20 right here basically means is that, simply put, on average, we will win $20 for every trade. So if we take a large amount of trades, these trades will give us an average of $20. So this is why it's important to backtest your trading strategies. You have to have an estimate of the win rate of your trading strategy as well as your risk to reward ratio. By knowing this, you can calculate the expected value of your trading strategy, and basically if you have a positive expected value, you will make money over time. You will of course have some costs associated to your trading, so make sure to take that into account, but if you have a large enough expected value, you will make money over time. But if you have a negative expected value, that is a trading strategy you want to stay far away from. Alright, so now when you have learned 5 of the most important lessons when it comes to day trading, you are ready to learn about a day trading strategy. So now I highly recommend all of you to watch this video next.